Hello everyone, hope you are doing well. The first half of the year has come to an end, and the stock market has its worst start in about 50 years. In this video, I will share my views on what's ahead after this brutal first half of 2022. As usual, there will be a segment where I cover the technical analysis of a few mega cap stocks. Do also stay till the end as I discuss on what a normal buy and hold long-term investor can consider doing in this bear market. But before that, I'm hoping to grow this channel. Therefore, if you like such videos, I hope you can help me with the like and subscribe buttons. It will really help with the YouTube algorithm. Okay, the stock market had a little rebound towards the end of the trading hours on Friday. Despite that, the S&P 500 is still in the bear market, with about 20% decline from its peak on 3rd Jan 2022. This is actually its worst performance for the first half of any year since 1970. That's 52 years ago. By now, we all should know the reasons why the stock market has tanked. It's because the economy is battered by high inflation, rising interest rates, as well as the war that broke out earlier this year. All this have affected companies' profits and dented consumers' and investors' confidence. And so far, the sell-off in the stock market is nothing but remarkable. As we enter the second half of the year, I believe most investors are still searching for the bottom, so I would want to spend a little more time for this segment. Okay, so to have a bit of sensing or indication on whether we are near the bottom would be to look at the root of the problems, which are the events that I have mentioned earlier. Let's do a quick breakdown. First up, the war. Clearly, the war needs to cease to ease supply chain issues and also bring down prices of some of the commodities. Then we have the CPI data and inflation. The next CPI data will be released on 13 July. The data must show improvement. To recap, the last reported CPI figure is 8.6%. If July's number is lower, then we may have a little relief rally. But if it hits say 9%, I think we can expect some bloodbath. Next, interest rate hike. To recap, last month, the Fed increased the rate by 75 basis points, higher than the originally planned 50 basis points. So in July, keep a lookout if they are going to retain this 75 basis point or will it shoot up to 100. This could very much depend on the CPI data. For info, FOMC meeting is scheduled for 26 and 27 July, so do mark these dates in your calendar. Last but definitely not the least, I thought this is something noteworthy to highlight, and that's the earnings report and guidance from the various mega cap companies, as well as the major banks. Note the word "and". Some investors often wonder why when a company beats the analyst estimates in terms of earnings, but the stock still falls. Sometimes it is due to the poor guidance provided by the company. In other words, they are pessimistic about the economy ahead. Therefore, as we enter the earnings season, I feel investors should be more careful when making any moves in the stock market. All in all, it is going to be an eventful month ahead. Personally, I am expecting significant volatility beyond July. There could be some relief or oversold rallies here and there, with shorts covering their positions. But as long as the earlier events or issues do not get resolved, I believe these rallies will not sustain. My view of short the pop and sell the rip still stands, a view that I have mentioned since last month's video on June market outlook. Back then, SPY was at around $410 and it is currently sitting at around $380. Okay, now let's move on to the technical analysis segment, starting off with SPY. I will spend a little more time here as S&P 500 can kind of give us a good indication of the broader stock market's performance in the coming weeks and months. On 29 June, I posted on Mumu that there seemed to be an evening star pattern formed, and if the pattern is confirmed, it is usually quite reliable and could mean the next downtrend has begun. As of Friday 1st July, when the market closed, it didn't show much confirmation that the downtrend has started. But that said, we are not out of the woods yet as the chart is looking weak at the moment. So why do I say so? Let's have a look at the Fibonacci retracement level drew from March's high to the recent low. The stock is trying to bounce up at the moment, and with Friday's late push, it is still below the first Fibonacci level at 385. If it breaks above, it needs to fill out the gap between 394 to 399 before we can say that it is slightly bullish. Coincidentally, 399 is also the next Fibonacci level after 385. So in short, as long as it is below $400, we are still bearish. On the downside, there is a little gap between 369 to 370 that once again will act like a magnet to pull the stock down. Anyway, I'm just thinking aloud. Say for instance, the major companies report missed earnings with poor guidance, inflation is still sky high, and Fed has to go even more aggressive in terms of interest rate hike. I wouldn't be surprised if it breaks the recent low of 362. On the weekly chart, I just wanted to highlight two key levels on the downside based on Fibonacci levels, and they are 345 and 313. It may sound a little crazy if SPY moves to 313, as that is the pre-COVID peak. But well, you will never know. I'm just putting it out here first so that investors do not get a shock if it hits towards that range. But before that, I believe 200 moving average should offer a strong support, which currently stands at around 340. Lastly, I also wanted to highlight that it seems like after every CPI data release and FOMC meeting, we will create a lower low. I'm not sure if it will happen again this time. But once again, just bringing this up to mentally prepare investors out there. Don't be too alarmed if it happens again. Meanwhile, S&P 500 could chop around the current range and remain range bound leading to the earnings season. Okay, Apple. It seems to be bouncing around two key levels that I have mentioned in my last video, 137 and 140. As it is currently standing at around 139, the next target will naturally be 140, followed by a little gap at 140 to 142. Looking at the Fibonacci retracement levels, it also shows that 140 is the first big hurdle it needs to cross before we can unlock more upside at 148 and 150. So let's see if it will move towards to fill the gap above leading up to the earnings report. Otherwise, there is this very tiny gap at the bottom waiting to be filled too, which is around 133. In my view, as long as it is below 140, the trend is bearish. And for your information, 137 is a major support level based on the weekly chart. Therefore, the longer we stay below 137, the higher the probability that we will start to hit 120's range. Moving on to Tesla. Over the weekend, Tesla reported their delivery number for the previous quarter, and it is very close to what the Wall Street has estimated. But don't ask me whether the stock will fly or fall when the market opens on Tuesday. As I have always said, let the market makers go first. A look at the technical chart shows that it has been range bound since May, floating around 600s to around 750. Seems like bulls and bears are fighting each other and there isn't a clear-cut winner yet. Also, to add on, there is a long-legged doji on Friday, which means there is indecision between buyers and sellers. But as we enter July, with so many things gonna happen, we should see big movement for Tesla, and it could be as early as Tuesday. On the upside, as I have always mentioned, 746 is one key level to keep an eye on, followed by 800 and 823. On the downside, if July's events all turn out to be headwinds, for instance high CPI figure, high interest rate hike, poor earnings, etc., we will finally see 500's range. Here's a quick one for Microsoft. For those who have followed my videos, you would have known that there is this consolidation zone that I have drawn quite some time ago, at around sub 200 to 220s. Day by day, it seems like it is possible for us to reach that area, and I am still waiting patiently for it. But a quick disclaimer, this is not a prediction that it will hit that range. It may or may not happen, alright? So this brings me to the next point. I am considering entering a small bit at 240 or maybe high 230s. Next, Nvidia. I have posted on Momo that there were two gaps to be filled. As of today, the first one has been filled, with another one more to go, between 140 to 142. As also shared on Momo a few times, there is this descending triangle formed on the chart, and this is a bearish pattern. True enough, the stock is breaking downwards and created a new 52-week low. In terms of entry point, I am waiting to enter a little bit at 140, but this is not financial advice, okay? Other investment gurus are saying there will be more downside to this stock, so please do not follow me blindly, do your own research too. Please also note that whichever target prices of entry mentioned in this video are subject to change, especially with so many events coming up in July. Next, Amazon. Decided to cover Amazon this week because of the potential head and shoulder pattern formed on the chart, which I have also posted on Momo on 23rd June. For those who are not aware, head and shoulder pattern is a bearish pattern, so keep a lookout for the support level or neckline at around 101. Things can get really ugly if the earnings or guidance are not up to expectation. A new 52-week low could come into picture. Another new coverage for this week, AMD. It is looking very bearish at the moment. To me, it looks like it is breaking down from the bear flag pattern. Watch out for key support levels at 72 to 73. If this breaks, we could hit towards the gaps at the bottom and probably hit $58 to $60. Okay, my end thoughts are, I believe there could be more pain ahead as we enter the second half of the year. In my view, recession is almost inevitable. Previously, I have done a video on recession vis-a-vis the stock market. You can check out the link on top or in the description box below. Once again, I would like to highlight that earnings season and new CPI data are coming out hot and fast, and the market can make drastic movement up or down. Nobody will know the exact direction, so if you are not confident in navigating through this period or not good with earnings play, you may consider staying on the sidelines. For average long-term buy and hold investors, you could be feeling worried about this bear market, and some of you could be a little lost by the vicious stock market sell-off. This will be even more true for new investors who started their investment journey during the COVID recovery period, when the Fed printed almost unlimited money to stimulate the economy. For such investors, I'm not going to advise on the exact actions to do or what stocks to buy, just purely sharing my thoughts here, and that is, be prepared to make changes to your investment or trading strategies. For instance, if you have been doing the DCA strategy monthly and it is troubling you as the market dip each time, you can consider spacing out the DCA moves with longer time frame, such as putting your money into the market every 2 months. Alternatively, you may pause your buy the dip strategy completely and take a short break from the stock market. It is okay to hold cash and not pump in more money in a period like this, but I wouldn't recommend selling any good company stock at the loss if you are a long-term investor. Again, this is not financial advice, alright? For me, I am still cautiously putting my money into the market by lowering my price targets for the stocks I want and enter at key support levels. I am also doing a bit of option trading to generate small amount of cash monthly. Alright, that's all for this video. If you have found some value in this video, I really hope you can hit the like and subscribe buttons. They mean a lot to me and will keep me going. Thank you.